Welcome to the Forex Base A Camp channel. We will discuss liquidity and volatility in the Forex market. The dynamics of liquidity and volatility in the Forex market are different for each pair, and this can affect your trading profitability. Maybe you've heard the statement that the Forex market is the largest and most crowded financial market in the whole world. The reason is because the Forex market has very high liquidity and volatility. Even the Forex market is the most liquid type of financial market compared to the stock, commodity or bond markets. But, do you know what it means to the liquidity and volatility of the abundant Forex market? The following explanation. Forex market liquidity. In the stock market, we will not get the buy price according to what we want if there are no parties to sell at that price. Often, we must queue to get the buy price of shares in accordance with our trading plan. Such a queue does not occur in the Forex market. Whatever the buy or sell price that we want when trading Forex will definitely be realized, either through a pending order or directly entered at the current market price. The definition of liquidity is how easily a financial asset is converted into cash. The Forex market is the most liquid market, because we can open and close trading positions very easily. The total transaction value on the Forex market reaches US $4 trillion per day, a record for the largest trading volume in the world. This allows you to enter and exit the market at any desired price. However, not all currency pairs are traded in high liquidity conditions on the Forex market. There are certain currency pairs that are very liquid, but there are also those whose liquidity is more minimal. The EUR-USD pair is far more liquid than the EUR-TRY pair, Euro versus Turkish lira. The USD-JPY pair is also certainly more liquid than the USD-MXN pair, US dollar versus the Mexican peso, or USD-IDR, US dollar versus rupiah. All major currency pairs offered on the Forex trading platform are generally liquid currencies. The question is, how do we know whether a currency pair is liquid or not? There are several ways to find out liquidity in the Forex market, including 1. The size of a currency pair's liquidity can be seen from the size of the spread pegged by the broker. Spreads for EUR-USD are usually 1 pip or 2 pips, while EUR-TRY spreads are between 16 to 20 pips, as well as USD-JPY spreads are generally 2 pips or 3 pips, while USD-MXN is 8 pips to 12 pips. 2. The quantity of a currency pair on the Forex market is also determined by the size of the trading volume. The less a currency pair is traded, the lower the liquidity of the currency pair. Forex market volatility. Traders in financial markets also need to pay attention to volatility, namely the distance of fluctuations, up and down, prices. Why is that? After realizing an order from a planned transaction, you certainly need adequate price volatility with a reasonable range of price movements. If the price only moves choppy back and forth on a very narrow range, of course you cannot realize the trading strategy according to the plan because the price failed to reach the target profit. Not all liquid currency pairs in the Forex market will always move with high volatility. Likewise, less liquid currency pairs can sometimes move with very high volatility. For example, USD-JPY is one of the major liquid currency pairs. But the average volatility of USD-JPY is usually lower compared to GBP-USD or EUR-USD. Simply put, a measure of volatility can be known from the range of daily price movements. Range varies for each currency pair and will continue to change from time to time. Also read, time and hour for Forex trading. Why do Forex traders need to understand liquidity and volatility? An understanding of liquidity and volatility in the Forex market will enrich your insight about market conditions. When are good market conditions for entry, and when market conditions are unfavorable for trading? Changes in the volatility of a currency pair can occur due to market sentiment due to certain news or in connection with important fundamental news releases. High volatility can also occur because of speculators who enter into large numbers when trading volume is thin or liquidity is declining. For the latter, the effect is only temporary because basically there is no trader who can fry the Forex market as happens in the stock market, except with very large syndicated funds. The highest liquidity of the Forex market occurs during overlapping meetings, trading sessions in Asian markets, the London market and the New York market. Precisely between the hours of 8 o'clock Greenwich Mean Time at 1500 WIB to 1800 Greenwich Mean Time at 1 o'clock WIB. While relatively low liquidity occurred in the Asian session and towards the close of the New York market. In addition, the liquidity and volatility of the Forex market will be very low on holidays that occur simultaneously, especially before Christmas and the New Year. It is recommended not to enter the market on those low liquidity days. Like and subscribe.